The debt-to-equity ratio for Seacom was an unorthodox 25% debt and 75% equity. At the commencement of construction, the IRU commitments amounted to more than 1.25 times the total debt funding. That significantly reduced the credit risk exposure of South African banks, Nedbank and Investec, who were the debt capital providers. From a banker's perspective, the IRUs were critical and they significantly de-risked the project. It was ultimately absolutely vital, and it was possibly the single biggest factor that allowed the banks to do this particular deal. In addition to it being an important source of construction capital, the IRUs mitigated the naked risk that frequently compromised capital raising in project and infrastructure finance ventures. And the 25% to 75% debt-to-equity ratio may paint a somewhat incomplete picture because some of the investors had back-leverage structures on their equity contributions. Back-leverage structures occur where sponsor funds a portion of equity contributions to a project using debt off their own balance sheet. It's reflected in the sponsor's balance sheet, but not in the project company's balance sheet, where the inflow is shown as a pure equity injection. So the use of these back leverage structures has the effect of understating the degree of debt used to fund a project if only the balance sheet of the project company is analyzed. If we take into account the leverage taken up by the investors on their own balance sheet and it's included, we would likely see a debt-to-equity ratio in the region of 50-50. Whilst this is still moderate by project finance standards, it reveals significantly higher levels of overall gearing than the 25%, 75% we discussed earlier. Now, the back leverage structures have a number of negative effects. They had a number of negative effects for Seacom. Firstly, it led to a situation where distributions are pre-coded into the shareholder agreement, and there would be significant dividend flows right from the start. This has contaminated the medium to long-term decision making, and there's a tension arising between whether dividend payments should be made or reinvested into the company for future growth strategies. It's also notable that Heracles, as project founders and promoters, received a proportion of shares in the project company as a free carry, as compensation for having shaped, conceptualized the opportunity and the costs and risk of losses if the project had failed to materialize. A final consideration in the conservative capital structure arrangements related to the fact that it's not possible to insure an undersea cable. So by retaining significant capital reserves, Seacom in effect self-insured its infrastructure, and it created another layer of protection from unexpected occurrences. Following the completion of the construction phase and the operationalization of the project company, Seacom set out to restructure its capital structure in the period around 2009 to 2010. The aim was to increase the debt levels to $150 million relative to the total capital of $300 million, and thus achieving a debt-to-equity ratio roughly of 50-50%. The Seacom project also has a natural hedge against foreign exchange risk. 95% of its income streams are denominated in US dollars. That gives it a natural hedge against the foreign exchange risk.